Welcome to this 13th episode of our tax update series. I'm your host, Andy Rainford. I'm a chartered tax advisor and content editor at Tax Essentials for Advisors. It's been a quiet month in terms of tax news so far. That's not really surprising, as the budget is fast approaching, but I've still got some snippets to talk about, including a key payment deadline, an important reminder about child trust funds, and a case involving mistaken identity. Sort of. So first up, the deadline for making payments of amounts due under a PSA for 2024 to 25 is imminent. It falls on the 22nd of October, so if you haven't already paid, make sure you don't miss it. A PSA has to be agreed with HMRC in advance. If you have one, you should have received a payslip with the appropriate reference to use to make the payment. Note that this is distinct and separate from your normal payroll reference. If you haven't received the payslip, you should use the reference from the letter HMRC sent you when you agreed the PSA. If you can't find that, contact the employer's helpline to obtain it. The Scottish Government has confirmed that its budget will take place on the 13th of January 2026. This is later than usual, which is understandable given that the main UK budget isn't until the end of November. The Scottish budget usually takes place in December, but the later date will allow Holyrood to absorb and consider any UK-wide measures that could affect its plans. Young people may be missing out on their child trust funds, according to a campaign from HM Revenue and Customs, which says that 750,000 matured funds are sitting unclaimed. The average balance is over £2,000. Those aged between 18 and 23 will receive a letter urging them to check to see if they have a fund waiting to be claimed. There is a useful tool for doing this at the link shown here. All you will need is your NI number and date of birth. Another one-to-many letter is being sent to individuals thought to have omitted dividend income from their 2023 to 24 tax return. As this return is still in time to be amended, you can correct any mistakes before the 31st of January 2026. The letter says that interest and possibly a penalty will be charged. The level of the penalty will depend on how cooperative you are with correcting matters. However, this will almost certainly be lower than if nothing is done, and an inquiry is required. A new dedicated helpline is available until the end of November if you are unsure about whether you need to take action. On to cases, and again, there weren't that many to choose from. Plenty of VAT ones, but I'm leaving those for the new VAT update series, which has recently launched. In this case, a company had included a gain realized on the disposal of a property on its 2010 tax return, paying corporation tax. But in fact, the property had been owned by an individual. They would have qualified for private residence relief, meaning no tax should have been paid at all. Coincidentally, there was an inquiry into the return that closed in 2019 due to a related matter. The company didn't appeal the closure notice within the 30-day window. When a new accountant was appointed in 2023, the company sought permission for a late appeal. The tribunal noted that there was no subject matter to appeal, as the company had simply made a mistake on a return, which was well out of time to correct. Well, that wraps up this short update. I am pleased to announce that our next webinar will take place on the 13th of November at 1 p.m. I'll be welcoming renowned VAT expert Neil Warren to talk about VAT in the construction industry. We'll be looking at this from the perspective of both contractors and subcontractors, so it will almost certainly have something that could help your clients. I will have a registration link for you in the next update in 2 weeks. Until then, it's goodbye from me. Thanks for joining us.